In 2022, much of the world experienced a period of uncommonly high inflation. The US, UK, and Eurozone all peaked at around 10%, meaning that prices on average were a full 10% higher than 1 year before. This spike in inflation caused significant stress, particularly in the grocery store as prices soared. Though inflation is thankfully now closer to the normal range, it remains somewhat elevated. However, this doesn't mean prices have decreased suddenly, that they've stopped climbing as fast, which is still a source of frustration for many. Consumers are stressed, businesses are suffering, and governments are scrambling to manage the situation. Amid this chaos, you'll often hear, "A little inflation is a good thing." But why is that? If rising prices hurt seemingly everyone, why can't inflation be zero? Inflation at zero is not desirable because governments and central banks actively pursue an inflation target. In the United States, this target is about 2%, a figure also used by most central banks globally. This target helps create what economists call a virtuous cycle. When prices rise, people expect them to continue rising, prompting them to make big purchases now to avoid higher costs later. This increased spending boosts company profits, leading to more jobs and more spending, sustaining the cycle. As long as wages rise with inflation, purchasing power remains stable. However, wage growth in the U.S. lagged behind inflation for 2 years until mid-2023, when it began to keep pace, especially for lower-income earners. This improvement is crucial as wage growth helps maintain purchasing power. Disruptions in this cycle, like supply chain interruptions and companies artificially increasing prices, can turn this virtuous cycle into a vicious one, leading to high inflation. Governments combat rising inflation by raising interest rates, making borrowing more expensive, which slows down the economy. This strategy, used by the U.S. Federal Reserve in 2022, helped bring inflation closer to the 2% target but also increase financial strain on families. On the other hand, deflation, or falling prices, can trigger a deflationary spiral. When prices drop, consumers delay purchases, expecting even lower prices, which reduces overall spending. This leads to lower company profits, job cuts, and further reduced spending, causing economic growth to slow. Periods of true deflation are rare and challenging to fix, as governments have fewer tools to combat it. For instance, during the Great Depression, deflation was mitigated only by the economic boom caused by World War II. Japan has recently emerged from decades of chronic deflation, partly due to the high inflation faced by much of the world in recent years. Inflation targets help prevent deflation. If inflation sits at zero, any economic shakiness could push it into the deflation zone. To avoid this, maintaining a slightly higher inflation rate is essential for financial stability and sustained purchasing power.